What does the future of banking look like? We'll go over Richard Warner's, George Gammons, and Jeff Snyder's, at least what we think their views are, and then we'll give some of our own. So, Justin, let's roll right into this.
Absolutely. So Warner this past weekend in Houston, his big point was he continually mentioned the importance of small community banks. You want more and more and more of them. The reason being, in a nutshell, small community banks, they understand the community. They are integrated with the community. Small banks make loans to small businesses. Small businesses are arguably the backbone of the community. So this is a very good way for the community to invest in of itself. Of course, there's still a role for large banks too. However, when it comes to large banks, typically they will make loans and do financial servicing to large customers, which might be in some communities, but certainly not nearly as widespread or as ubiquitous as small businesses who will need small banks on that front.
Yeah, just from a historical perspective, that we've seen the greatest results in the free market when there were the most amount of banks. We have the entire century of 18 to 1900 of the free banking period, where there was just more and more banks being created, lending to small firms, small entrepreneurs, building the businesses that are useful in our everyday lives. Then we see in Germany, the most hidden champion businesses because they have so many more banks than everyone else, and they can lend to the people they know will be good on their money, because these banks, the small banks, know the community much better than the large banks ever will, and they're much more willing to lend to them, just as Justin was saying.
And another thing too is that the person in charge of China after Mao, was it Taiping?
He let the free market start creating banks.
And even in communist China, even in closed anti-free market communist China, they put in this one reform, and it did really, really well over there too. So the point is that Warner, I think, would make the argument and back it up rather powerfully with the fact that, listen, the more community banks, the more small banks you have that are integrated with the community, the more productive the community becomes, because the more, and this is the important part, the more the local bank can act as the intermediary to facilitate loans, or say this another way, to vet projects that make sense, that will empower, that will help build up, that will help strengthen, et cetera, the local community. And you've got to do that on the local level. So that was the key thing on that point.
Now let's go into George Gammon. Says that banks need to be restricted by an asset they cannot create. So right now, banks can, if you don't know, banks they create money. If you take out a loan, money is then created. The bank just types digits onto a screen, and there you go, poof, money is created, and there's absolutely no restriction there. So what is the restriction on the bank? It is when banks intertwine with each other, and they have to pass on these dollar liabilities onto other banks' balance sheets. So basically right now, the only way a bank can go bust is if all other banks collectively agree that they will not accept dollar liabilities from those banks. It might sound kind of complicated, but it's simply an accounting. It's just an accounting error that would make your bank go bust.
Yeah, actually, I would even drill it down simpler than that. One of the things that Gammon has mentioned, and I would agree with, is that you see this financialization of the economy. That is to say, the financial economy drives the real economy. It's kind of like a pushing rope in a strange way it works. And I think what goes on in this particular situation is that banks need to be rewarded for making prudent loans to prudent projects, that actually need the capital. Large banks can lend to large companies, medium banks to medium companies, small to small. That, I think, very much makes sense. But when it's changed, where banks can basically change and pass off any bad loans that come in, or banks are more incentivized just to create money and not necessarily to do the process of vetting a project, that's when you get this problem. That's when you get this misallocation of capital, or banks just simply not caring. Banks, it's the meme of, the guy with his girlfriend turning around and looking at the other girl walking down. Banks aren't doing the real function, that is, figuring out which projects make the most sense to allocate new capital to, rather just saying, okay, what can we do to make a financialized product to deal with the financialized economy? In other words, they're making all their money from making money, which is not necessarily what you wrote the role of the bank to be. And this gets back, I think, to Gammon's point, as well as the point that Breedlove has echoed, Snyder has echoed, and I would assume Richard Warner would echo the same thing too if he was asked, although I have not yet asked the question, is that you want banks to also be responsible for the failures, because if they're responsible for the failures, it puts discipline and imposes discipline on the bank itself to say, okay, listen, does this project we're considering make a loan to, does it actually make sense? Do the founders or do the principals know what they're doing? Do we think there's actually going to be a return on it? And likewise, what this means is that the more of these small banks you have, if one bank says no, the people who are trying to shop the project or trying to seek a loan to start a business, factory, or whatever, they can go to another bank, and the other bank might say yes, just depending upon their internal risk profiles. But the key point is that you want, in addition to the first point, more community banks. You also want banks, whether they're small, medium, or large, to be constrained. And the constraint that's imposed upon them is that customers can go to the bank and demand delivery of an asset that the bank cannot fabricate out of thin air.
In the past, this was gold. Gold is something that these banks cannot create, and it restricted them to where they didn't want to make bad loans. Right now, there is no such restraint on a bank that they cannot create besides the reserves.
Yeah, or Josh, let me say this a slightly different way. When you had that tangible reserve asset, that was the physical manifestation of the public's call of confidence on the bank. In other words, if enough people lost confidence, that is the public, general public and free banking, lost confidence in a bank, they just come and demand all the gold, and the bank would be bust, so be it. But in today's world, as you actually say, the only thing that can cause a bank to go bust is a lack of confidence with other banking members. Yeah. See, that's the catch. That's, I think, the piece of the puzzle that is broken, and it just so happened to be broken in a way that's very convenient for the banks. What's the phrase? Tee oops, who would have thought, Snyder's view, which I've taken from his interviews with Breedlove, is this: you want banks to handle the capital intermediation process. That's just a very fancy way of saying you want banks to figure out, does this project that's asking for a loan, does it make sense? Will they make money or will they go bust? Banks actually, I think, can do a very good job of vetting and during this function. So that's where you have something out there. But the point is that, and this goes back to the Snyder's point, you want a monetary system that allows for that's elastic, that can inflate and that can deflate. And so if you just have a system that is set, that leads to its own problems too. Just like if you have a system that we have right now where you can just print up infinite numbers, okay, well, that's problematic as well. And so I think and this is the accountant in me speaking from way back in the day, is that when it comes to the business world, like, you would separate various functions in a company if you're looking at internal controls or internal audit. And so I think the same thing is true of the banks, where the banks right now have kind of been put, granted, maybe they put themselves there, but this is the takeaway. The banks have put themselves, or the banks have found themselves in an impossible position where it is in their best interest to, I don't want to say do shenanigans, but to maybe stray from their true mission. And that's figuring out, should we make it, or should we not make this loan? Or perhaps, well, we think you've got a decent project, Mr. Entrepreneur, but we have a little concerns. Take back version 1.0, do some work, and maybe come back with version 2.0, and we'll be good to go. Like that's like, the role of like a guidance mentor.
Financial markets, basically. The bank's goal should be the intermediary between the entrepreneur making the business
and serve as a check on the entrepreneur. And while it can be annoying to be an entrepreneur, like, you kind of want that, like, a structural mentorship, or I think there's an argument to be made from that structural mentorship. The point is, I think there's a role for banks, and I think all three of I think Snyder, Breedlove, Gammon, and Warner would agree with this. Yeah, or all four of them would agree with this, where you want banks to serve this function, but the way it's set up right now is that banks, they're not incentivized to properly serve their function.
Yes, exactly. So here's what I think the ideal banking system would look like. We would have as many as possible small community banks as possible that had a restriction that they could not create. I think Breedlove would argue that was Bitcoin. I'm not sure what it would look like.
Your point. Here's the cool thing. Gold. Banks, multiple banks can use multiple assets. That's the cool part. That's the cool part.
Just the bank should have a restriction that they physically cannot create. And these banks should just be focusing on making loans to people who want to start businesses and increase the productivity of our society. Something that I would add that I think Snyder would probably agree with is, I think there needs to be complete transparency and anonymously. So every single transaction that is done, I think, should be tracked and put in a database where everyone can see. But I think every single transaction should be completely anonymous. So you don't know who's transacting what and what banks are loaning. But I do think it's very important to see the data that every single transaction, so we can see what is actually going on with the economy. And if we do that,
or perhaps maybe, Josh, a good way to think about this is like the voting system. You want the votes for whoever you and I vote for. You want our vote to be anonymous, but at the same time, you want to make sure that every person only has one vote. And what's more, I, as the individual, should be able to see, there is my vote in a public record that's been counted. So you need both the anonymity as well as the accountability. And it's really interesting balancing those two things together, because you think back to, one of Snyder's big beefs, and, like, honest to God, not that I like to give, the Fed to pass on anything, but I can at least sympathize with them in this regard. When they struggle to talk about the monetary supply, this is the problem, because it's not transparent. Like each bank is kind of its own little fiefdom. And again, it gets back to what I said before. Banks have allowed themselves, perhaps out of their own self-interest, to be put into this very awkward, if not impossible, situation. And so I think this is very much to your point, where if you have something, again, Lord help us if we, or when we get to CBDCs, but I think that would be a very interesting take on it, because if you have everything being done in crypto land, and if crypto can preserve the anonymity of the transaction and still maintain the accountability of the transaction, that actually might be a very interesting squaring of the circle, because you could see what's going on with the monetary supply. You could see how the flows are going, assuming you could also preserve, the financial privacy aspect of it as well.
Yeah.
Hard circle to square.
This is, I think, would be the perfect free banking era, but this is not what's happening.
At least not happening yet.
Yes. So right now, what has actually happened is we're having fewer and fewer banks with more concentrated power getting bigger and bigger and bigger. In fact, we have central banks coming out that are trying to take over that power, which if there was to possibly just have one massive bank, which is the complete opposite of what Warner thinks would increase productivity at the maximum capacity. And then we also have the restrictions being there are no restrictions on the bank, and especially when these banks get bigger and bigger and there's less of them, because there's just a higher probability that these banks say, okay, I'll take your dollar IOUs on my balance sheet, I'll take yours, we won't exchange assets, boom, no bank will ever go bust. And then
and we're going to be very restrictive who else we let into our system too. Or we'll put up these false barriers where, in other words, if you want to be part of the club, you've got to do these onerous compliance procedures, spend or whatever, right? So there's ways that the system perpetuates.
And in Snyder's case, banks are now not focused on making loans, but on financializing the economy more and more, which is not the goal of what the bank should be doing. They should be focused on making these loans. So we are getting further and further off course of what the smartest people in the room think would be the best situation.
So Josh, basically, I think the conclusion here is that, to kind of sum everything up, more banks is better than fewer banks. Smaller banks plugged into the community is better than just a few large banks that maybe might not necessarily be plugged into their community. You want banks to be accountable. So you want to have a reserve asset that the banks can't create that can be demanded by the depositors should depositors ever wish to withdraw their confidence, the reserve asset, from the bank itself. And lastly, ideally, you'd want a system that would allow us to run the economic model so we could actually figure out what the monetary supply was, and at the same time preserve the anonymity of individual transactions between businesses and individuals.